Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of investment banking fees and commissions, what clients need to know. Investment banking plays a key role in major financial decisions, from raising capital to managing mergers. But understanding the fees and commissions involved can feel overwhelming. These costs vary widely and have a direct impact on clients' bottom lines. For businesses and individuals, knowing what you're paying for, and why, is essential to making informed decisions. This video breaks it all down, so you'll know exactly what to expect and how to plan. Understanding investment banking. Investment banking serves a unique role in the financial world, acting as the bridge between companies and the capital they need to grow. Whether it's helping businesses expand, advising on mergers, or tapping into public markets, investment banks play an active role in shaping financial strategies for corporations, governments, and large institutions. To fully grasp how these banks operate, you need to understand their core functions. Key functions of investment banks. Investment banks aren't your typical banks. They don't handle checking accounts or offer savings plans. Instead, their focus is on high-level financial transactions. Here are the key areas they specialize in. Underwriting. At its simplest, underwriting is about raising money. Companies looking to go public or issue debt rely on investment banks to connect them with investors. The bank assesses the risk, sets the terms, and often buys the securities outright to sell them to the market. By doing this, they ensure businesses get the funds they need while investors gain access to new opportunities. For example, when a company launches an IPO, initial public offering, the investment bank doesn't just act as a middleman. It prices the stock, promotes it, and guarantees the company gets paid. In short, underwriting is where investment banks bring ideas to life, transforming a company's goals into tangible funding. M&A advisory. Mergers and acquisitions, M&A, are some of the biggest financial moves a company can make. Investment banks are the go-to advisors for these complex decisions. They help clients navigate negotiations, conduct valuations, and make strategic recommendations to finalize deals. Picture a company trying to decide whether to acquire a rival or merge with a partner. The stakes are high. Investment banks analyze every angle, ensuring these decisions are backed by solid data and a clear roadmap. Their expertise reduces risks for clients and increases the chance of a successful outcome. Capital raising. Raising capital isn't just about underwriting. Investment banks also help businesses access funds through private equity deals, loans, or other financial instruments. These efforts support everything from expansion plans to debt refinancing. By leveraging wide networks and market insight, investment banks match companies with the right investors or lenders. The goal? To raise cash efficiently while aligning with the company's long-term strategy. Investment banks are at the heart of the financial growth process. Their services go beyond transactions, they bring expertise, strategy, and connections to every deal they touch. Understanding these key functions can help clients better evaluate the services they're paying for. Types of fees charged by investment banks. When investment banks provide services, they don't work for free. Their expertise comes with clearly defined fees, which vary depending on the service. Whether it's guiding a company through a merger, helping them raise funds, or underwriting securities, the fees ensure the bank is compensated for its work. Let's break down the main types of fees clients might encounter. Advisory fees. Advisory fees are charged when an investment bank provides strategic advice, particularly for mergers and acquisitions, M&A, or corporate restructuring. These fees are typically calculated as a percentage of the total transaction value, though the percentage can vary based on deal size and complexity. For example, in M&A deals, larger transactions often have lower percentage fees due to the sheer scale of the deal. A $50 million acquisition might command a 2% advisory fee, while a $1 billion merger might drop to 0.50%. The logic? Larger deals require a similar amount of expertise but involve much higher stakes. Clients are essentially paying for in-depth insights, risk evaluation, and negotiation tactics. When it comes to restructuring services, such as managing debt or reorganizing assets, these fees reflect the extraordinary complexity of the work. Investment banks analyze financial health, coordinate with creditors, and propose solutions tailored to address the client's needs. The fees justify the bank's role in bringing resolutions to otherwise overwhelming situations. Underwriting fees. Underwriting fees come into play when a company issues new securities, such as during an IPO or a bond offering. These fees are typically structured in a tiered way, involving three key parts: management fees, underwriting fees, sometimes called selling fees, and concession fees. Management fees. These compensate lead underwriters for coordinating the deal. They're relatively small, often representing a fraction of the total fee. Underwriting fees. Paid to underwriters for taking on the risk of buying securities and reselling them to investors. Concession fees. Compensation for the sales team responsible for marketing and distributing the securities. For IPOs, the total underwriting fee ranges between 5–7% of the total funds raised. In bond issues, the percentage is usually lower, often between 0.501%, because the process is less time-intensive and involves lower risk. Clients essentially pay for the bank's ability to price securities competitively and find the right buyers. Success fees. Success fees are payable only when a transaction is completed. These fees act as a performance-based reward for the investment bank, incentivizing them to get deals across the finish line. In an M&A scenario, a success fee might be 1–2% of the final transaction value. The higher the deal value, the lower the percentage tends to be. For restructuring services, success fees often hinge on specific results, such as the amount of debt reduced or financial goals achieved. This type of fee structure benefits both parties. The client avoids paying large upfront costs without guaranteed results, while the bank stays motivated to deliver a successful outcome. Think of it as a win-win scenario that aligns the interests of both sides. Retainer fees. Retainer fees cover ongoing advisory services over a set period. These are fixed payments made regularly, such as monthly or quarterly, to retain the bank's expertise on call. Retainers are common in long-term engagements where the scope of work is unclear but consistent advice is required. For example, a company planning a multi-step transaction may pay retainer fees to secure an investment bank's attention throughout the process. This ensures the bank is available for consultations, financial modeling, and strategic advice whenever needed. Retainers allow the client to build a continuous working relationship with the bank without renegotiating fees for every consultation. Retainers can range from tens of thousands to millions of dollars, depending on the client's size, the bank's reputation, and the complexity of the tasks involved. Clients pay for convenience and access to expertise whenever they need it. Investment banking fees are structured to match the value and difficulty of the services provided. Each fee type reflects a different stage of the process, ensuring banks are compensated fairly while delivering results for their clients. Understanding commissions in investment banking. Investment banking isn't just about big deals and financial strategies. A significant part of the money these banks make comes from commissions tied to the services they provide. Whether it's brokerage activities or trading, commissions are central to how investment banks operate. Let's break it down. Brokerage commissions. Brokerage commissions are fees charged for executing buy and sell orders on behalf of clients. These are common in trading activities, where investment banks act as intermediaries between buyers and sellers. How they work. When you trade stocks, bonds, or other securities, the bank charges a percentage of the trade or a flat fee. This fee compensates the bank for the resources and expertise it uses to execute the transaction efficiently. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.